Okay, let's dive into this. Welcome to this explainer, where we're going to unpack a massive, fundamental shift that is happening right now in the world of algorithmic trading. We are rapidly moving away from those clunky legacy brokerage environments of the past, and we're stepping into the incredibly fast, highly optimized world of modern, high-frequency trading infrastructure. Look, if you've been relying on the exact same technology stack for the last decade, you are definitely going to want to pay close attention to the strategies and frameworks we're laying out today. I actually want to start our explainer right here with this incredibly candid quote directly from our source material. It says, "The glory days of quant devs and researchers for firms is dead. Go out on your own. Use the tools." Honestly, that perfectly sets the tone for our entire guide today. The old barriers to entry, they're completely shattered. Individual quants, retail algorithmic developers, and independent investors now have access to the exact same high-powered tools, data feeds, and execution engines that used to be strictly locked away inside massive institutional firms. The power is literally in your hands now, but only if you know how to build the right infrastructure.
So here's our playbook for today. First, we'll look at legacy broker API limitations. Second, comparing order flow data. Third, the case for Rithmic. Fourth, low latency C++ architecture. And finally, number 5, AI-driven portfolio allocation. Let's just get right to it.
All right, Section 1, Legacy Broker API Limitations. This is really the breaking point for modern quants. We're seeing models that worked flawlessly for 15 years suddenly fracturing under the intense pressure of current market conditions. It's wild. Here's a very real, sobering example for you. According to our sources, a market-making firm recently had to literally shut down their entire metals trading program. Why? Well, because the endless, relentless bidding in gold, that's the /GC ticker, and silver, the /SI ticker, completely crushed them. You see, their models were built on a mean reverting basis. But the market changed, the flow changed, and their legacy systems just couldn't adapt fast enough. Compound that with persistent futures data feed problems and an overly complex TWS API architecture, yeah, you've got a recipe for disaster.
And then there's just the daily headache of reliability. Look at this question. How do you get IB Gateway to stay online 24/7? I mean, imagine running an institutional-grade strategy, right? And your core connection just decides to sever itself and go to sleep right at midnight. If your bots need to run consistently 24 hours a day until Sunday, you simply cannot build on infrastructure that needs a bedtime. It just doesn't work.
Moving on to Section 2, Comparing Order Flow Data. This is all about finding your real-time data edge.
Now, what's really interesting about this slide is how it shows that large order flows are preemptive. They actually dictate massive moves in major tech tickers, specifically names like Micron and Intel, way before the price action even catches up. The flow tells the entire story. If you're out there scalping large order flow to exploit delta hedging effects, delay is death. You absolutely must see that order the microsecond it hits the tape, no matter what the underlying stock is.
So how do you actually get this data? Let's quickly break down the costs and features of the real-time options flow data services our top developers are currently leveraging. First up, you have Theta Data, coming in at a very accessible $160 per month, which is heavily focused on options flow trading. Then there's Data Bento at $200 a month, also excellent for options flow. And finally, you have Unusual Whales at $400 a month. While it's definitely a higher cost, developers explicitly highlight its incredibly strong REST API. Choosing the right feed is really about balancing that monthly overhead against the specific, robust technical features your execution engine demands.
Which brings us to Section 3, the case for Rithmic. How you go about pitching this platform switch to your investors.
You know, this right here is the classic boardroom battle. Investor comfort versus absolute technical necessity. Your existing investors probably prefer interactive brokers, right? It's a familiar, trusted name. But you have to explain the hidden costs to them. A notoriously difficult TWS API design, and serious futures data feed problems. Rithmic, on the other hand, is basically the modern quant's holy grail. It offers true high-frequency capabilities and superior real-time options support, which lets you monitor all expirations and all strikes simultaneously with advanced WebSocket filtering. When you need a formal argument to convince them to move that capital, this is your pitch.
To really prove why lightning-fast infrastructure like Rithmic is non-negotiable, consider this specific strategy from our source material. A 20-year MIT quant veteran is running a GC to GLD Chicago to NYC lead lag strategy. This is a highly intense, high-frequency system that exploits the tiny latency and price discrepancies between gold futures in Chicago and the gold ETF in New York City.
We're talking about a system firing off 20 to 30 trades a day exclusively on the GLD ETF. If you have legacy data feed issues on the future side, a latency arbitrage strategy like this simply falls apart. Your infrastructure has to be flawless.
And before a strategy like that ever even goes live, 700. That is the number of terabytes of historical tick data required to backtest a strategy of this magnitude properly. Our sources note pulling this massive amount of data from providers like AlgoSeek costing around $2,000 a month. The sheer volume required to validate an edge in today's market is staggering, and your architecture has to be able to ingest and process every single bit of it.
All right, Section 4, Low Latency C++ Architecture, Building the Actual Execution Engine.
When you're building for pure speed, C++ running on an Ubuntu Linux environment is still the undisputed king, but the code itself has to be structured flawlessly. First, you implement the eWrapper virtual abstraction callback designed to handle your incoming market data and execution events asynchronously. Second, you develop an interfaced strategy class. And third, and this is an absolutely massive time saver for developers, you pass that strategy around via a smart pointer client. Using this specific callback pattern and smart pointers is crucial because it ensures memory safety and rapid execution. Basically, it means you aren't forced to completely rebuild your core implementation from scratch every single time you spin up a new trading strategy.
But as our developers point out, traditional backtesting just isn't enough anymore. You have to hook it up live in a simulation environment. The critical trick here is to use real, live Rithmic data to feed your algorithms, but route the actual order execution logic to a custom sim environment. The data absolutely must be real so you know your models are calibrating correctly to current market conditions, even if the final execution of the trade is completely simulated.
And finally, Section 5, AI-driven portfolio allocation, the AI frontier.
And this brilliantly illustrates the modern AI portfolio strategy in action. You aren't just asking an AI to pick stocks, you're letting it dictate real-time portfolio weights. It maintains a 40% base allocation, but dynamically adjusts 35% based on real-time order flow signals and 25% based on forward-looking option expected values and real-time volatility. The AI is continuously recalculating whether you should take a large order flow signal based on these incredibly precise shifting weights.
So, the secret sauce here? It's the data pipeline. Artificial intelligence has made generating basic trading ideas incredibly cheap, but feeding massive market flow datasets into large language models, hooking them up to the absolute most up-to-date real-time market data, that is what creates incredibly powerful execution. Forward-looking option modeling needs to constantly recalibrate as the market unfolds. Parsing that massive stream of real-time data and adjusting on the fly, that is exactly what an LLM is built for.
I really want to highlight this quote from our sources because it just speaks volumes about the current landscape. I use AI every day, and this is where most people shut down, but this is where the value is. Pushing past the technical complexity of integrating LLMs with low-latency C++ architecture and massive real-time data feeds, it's hard, gritty work. It's intimidating. Most developers and firms simply shut down when they hit that friction. But if you want to generate modern quant alpha, pushing past that friction is exactly where the real value lies.
Which leaves us with this vital question to ponder. Is your legacy tech stack holding back your algorithmic alpha? If you're still relying on models from 15 years ago, struggling with API resets at midnight, and missing large order flows, the answer is almost certainly yes. It's time to evaluate your infrastructure, leverage these incredible new tools, and step confidently into the modern era of algorithmic trading. Thank you so much for joining me on this explainer.